Financial independence means having a steady stream of income, even if you're not actively working. To achieve this, you need assets that generate money on their own, enough to cover your living expenses. But what types of assets can not only provide a reliable cash flow to support your lifestyle but also shield you from market crashes and inflation? In today's video, we'll explore 5 powerful assets that can help you leave your job behind. Before we get started, make sure to like this video and subscribe for more valuable content. Let's dive in. Dividend yield is calculated as a percentage of the stock's price. So, if a company has a 3% dividend yield and its stock is priced at $100, it would pay $3 per share annually. However, yield alone isn't the only factor to consider when choosing stocks. It's crucial to invest in companies with solid financial performance and long-term growth potential. Building a steady stream of income from dividends is typically a long-term strategy unless you have a large amount of capital up front. For instance, if your portfolio has an average dividend yield of 3%, you would need $400,000 invested to generate $1,000 per month. Because of this, most investors use compound interest, reinvesting their dividends to grow their investments over time. Though it requires patience, this form of passive income is highly valuable because it requires minimal effort and is often taxed at a lower rate than regular wages. Real estate is widely considered one of the best ways to build wealth, and for good reason. First, property values tend to increase over time. In the early 1990s, the median home price in the U.S. was around $97,000. Today that figure has skyrocketed to over $400,000, meaning property values have more than tripled in just 3 decades. Another advantage of real estate is that you don't necessarily need to have the full purchase price in cash to acquire a property. Let's say you buy a $200,000 home, putting down $40,000 and financing the remaining $160,000 with a 2.5% interest rate over 30 years. Your total expenses, including mortgage, interest, insurance, and taxes, might come out to $830 per month. Now, if you rent out this home for $1,200 per month after covering all expenses, you'd be left with $370 in profit each month, or $4,440 per year. The key advantage of rental properties is that your tenants are effectively paying down your mortgage while you build equity and benefit from increasing property values. Additionally, savvy investors can use strategic financing to accelerate their wealth building. For instance, if your $200,000 property appreciates to $250,000, you can refinance and withdraw the $50,000 in equity. Then, you could use that money as a down payment on another $200,000 property, allowing you to control $450,000 in real estate with just your initial $40,000 investment. This strategy can quickly multiply cash flow, as you now own multiple income-generating properties. Bonds are often overlooked as an investment because they typically offer lower returns and may not always keep pace with inflation. However, they can serve as an important layer of protection, particularly during economic downturns, making them valuable for those nearing or in retirement. Legendary investor Warren Buffett once said that if he passed away, he would instruct his financial manager to invest his wife's money in a simple yet effective portfolio, 90% in a stock index fund, like the S&P 500, and 10% in bonds. To test this strategy, finance professor Javier Estrada analyzed historical market data and found that this simple approach outperformed many traditional retirement plans. Estrada also suggested a small adjustment to maximize the benefits of bonds in an investment portfolio. Since market crashes are inevitable, he recommends a dynamic withdrawal strategy. When the stock market is performing well, withdraw money from the equity portion of your portfolio to maximize growth. When the market is down, take money from bonds, which tend to increase in value during bear markets. By following this approach, investors avoid selling stocks at a loss and allow their equity investments time to recover. This strategy can provide financial security, ensuring that you maintain a steady cash flow even in turbulent economic times. According to Buffett, 90% of the funds should be placed in straightforward index funds like the S&P 500, with the remaining 10% allocated to bonds. To test how well this strategy would perform, finance professor Javier Estrada analyzed historical market data. To everyone's surprise, this simple approach outperformed the advice of many retirement investment experts. Estrada, however, took it a step further by introducing an additional twist to make the most of the protective benefits bonds can offer within an investment portfolio. The truth is, no one can predict when a market crash will occur. We only know that it eventually will. Therefore, it's important to have a strategy in place, especially if you're financially independent and relying on your investments to cover living expenses. Estrada recommends that once you're retired and withdrawing money from your portfolio, you should monitor the market's performance. When the market is thriving, it's wise to withdraw funds from the equity side of your portfolio, since it will be generating the highest returns. However, if the market is struggling and losing value, it's better to take money from the bond portion, as bonds tend to appreciate during market downturns. This strategy ensures that your equities can recover their value instead of being sold off at a loss. Many profitable businesses operate outside of the New York Stock Exchange. These can range from physical businesses like restaurants, coffee shops, franchises, or ATM machine networks, to online businesses such as apps or software companies. The goal here is to own the business while not actively running it. Not everyone has the skill set needed to successfully operate a business, and running one can be extremely demanding. However, many business owners prefer to hire individuals who have the necessary expertise to manage their businesses in exchange for a fair salary or a share in the company. While this type of investment can be more challenging than others, it offers several advantages. For one, owning a business gives you control over the cash flow and the profits you can take home. Additionally, business owners enjoy significant tax benefits, such as the opportunity to benefit from the dividend distribution tax, which is often lower than regular income tax. As a business owner, you can also use business funds for certain expenses before paying taxes, provided they contribute to the business. For example, if you own multiple stores, you could purchase a car using the business's money for visiting your locations. Since it's a business vehicle, you can buy or lease it with pre-tax dollars. Of course, it's important to consult a professional to ensure you're complying with tax laws and to understand what you can and cannot do with pre-tax funds. How many of you have wondered what it would have been like to invest in Amazon 2 decades ago, or to have gotten in early with Uber or Netflix? While we can't go back in time to invest in these giant companies, the good news is that new startups are constantly emerging that could potentially become just as successful. These kinds of investments carry high potential rewards, but they also come with significant risks. Typically, investors allocate only a small portion of their portfolios to such high-risk ventures, fully understanding that these investments could fail entirely. However, if they hit the right company, their wealth could skyrocket, taking them to entirely new levels of financial success. While all of these assets can make for great investments, the most valuable investment you can make is in your own education. Real estate can be an excellent investment for those who are well-informed, but for those who lack knowledge, it can be disastrous. Similarly, stock investing can build long-term wealth, but without financial literacy, you might miss out on key opportunities. Investing in your own education is the foundation for building a successful investment strategy and achieving the life you desire. Thanks for watching. If you enjoyed this video, give it a thumbs up and share your thoughts in the comments below. Don't forget to subscribe and turn on notifications so you never miss an update. See you next time.